listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey everyone, welcome back to another episode of the Daily Gold Podcast. Thank you so much for tuning in today. With me is returning guest, one of my favorites. He's Gary Tanashian. He is the editor and publisher of Notes from the Rabbit Hole, as he calls it. Love to get his take on gold and the macro fundamentals. In my opinion, he's absolutely one of the best out there when it comes to this. So, Gary, since we've talked last time, a month ago or so, we've seen the stock market come under a lot more pressure. We have seen aspects of precious metals come under more pressure, but I know you're looking at these gold ratios, and so where do you see things right now with respect to precious metals and how the economy and market looks to be rolling over, has rolled over in the case of the market?
Well, first off, Jordan, what I do is not to be promotional here, but point your listeners to NFTRH.com and check out a post called Inflation is Tanking. I put in a fairly sensational headline using a very rare exclamation point, which is just my way of getting attention, I guess. And in that post, there are a bunch of charts showing bearish commodities. Let's see, inflation expectations starting to just tip over, gold potentially bottoming versus that marker for inflation expectations, energy taking its first hard hit, copper sucks, copper gold sucks, the ratio, silver gold ratio has been trending down since the ill-fated silver squeeze goofiness. Commodities are intact, but took a hit last week. Natural gas took a solid hit. I think there was a fundamental supply-demand reason behind that, but oil is also coming down within its daily uptrend. Let's see, what else do we have there? And then the Treasury yields, which poked right up to like a super important level at 3.45% on the 30-year yield. In one of the recent posts at the website, I've got that marker there showing that it's really important in that's the 2018 high in yields. If we bust through there, we start a whole new secular regime, most likely in Treasury bonds, a bear market and bull market in yields. So last week with the exclamation point known as the Federal Reserve and its very well known interest rate hike of 0.75%, there's a sort of a breaking point there, sort of a sell the news. Everybody knows inflation is everywhere. So in that same post I was referencing, you have a headline, Fed promises unconditional approach to take down inflation in report to Congress. And that's what the public is seeing and believing, and why not? CPI is making records. Inflation is everywhere. We're all going to die an inflationary death. So it's very dangerous to be an inflation, a fully positioned inflation advocate right now, in my opinion. So how does that relate to the gold stocks? As I've kind of parroted forever, gold stocks are countercyclical. The example being Q4 2008, they're crashing. Even as I'm saying, oh my God, the fundamentals are screaming higher as gold rises versus oil, copper, commodities, stock markets, everything. And yet we crashed to HUI 150. So I'm going to say two things here. I think we're on the pivot. As we spoke about last time, we're pivoting to a very positive macro for gold stocks. But at the same time, there's potential problems there because the average gold bug, in my opinion, is also an inflation bug. So if inflation rolls over, even as gold mining fundamentals come screaming better, whereas like gold, for example, rises hopefully impulsively versus gold mining cost input crude oil, the inflationists will be selling. And so that sets up an opportunity if you're not fully positioned before it comes about. Now, I'm not making a prediction, but it's certainly in play if inflation is rolling over. The determiner here will be what percentage of the gold bull contingent right now is inflationist and in it for the inflation trades. You see what I'm saying? There's sort of a moral hazard built into this and a contradiction or paradox where the miners often get sold even as the time is finally flipping right to be a gold stock bull. And that's the thing I want to be aware of.
Right, because if you look on Twitter or just, listen to people, I'm sure some of, not all of your subscribers because, they're so sharp because they follow you. But a lot of people in gold and gold stocks and juniors, they're fully in all these other, they're in energy. They're touting uranium at the same time and, copper and, a lot of these things have really outperformed gold in the last couple of years. I try and make the point, like, there's some huge differences here. It's the same with silver, which, lags moves in gold.
Right.
So I guess my question for you is, how do we know if this is going to be, I hate to use the 2008 example because people were predicting another 2008 since 2009, basically. But How do we know if the end, the turn for gold is going to be more like 2008 or more like 2018, where it just kind of happened slowly, and you had gold quietly diverged from the market, including gold stocks? I guess that's something I'm thinking about. Is it going to be a combination of the two, or I think you had a blog post about that a week ago or so?
I'm thinking about the exact same thing, Jordan. I don't want to be an alarmist and or an automatic thinker, robotically just projecting 2008 to the current situation. So gold started correcting, and gold miners started correcting in August of 2020, right? Just as the inflation trades were starting to embolden and take off. And on the positive side, how much of the euphoria or optimism was bled out by that year and a half, or is it going on 2 years by now, of correction in gold and gold stocks as they improbably, to most inflationists, kept sliding down, not impulsively, but trending down, while everything else and its brother went up, some impulsively. So, the saving grace could be that gold stock started the correction in mid-2020. It was over bullish then. We knew there had to be a correction in gold. It needed to start making a handle on that monthly big picture bullish chart. And so, maybe that relieved some of the pressure, took out a lot of the gung-ho players. I just don't want to bank on that at this point.
Yeah, and, another point is if we think about, gold and the Fed, it seems like they've been hiking rates forever, but they've only been doing it for, we're in the third, not even 3 full months of that. But, real yields, I don't know if you follow that, but I retweeted a chart on Twitter. Real yields have been going through the roof recently. Yeah. And so gold has been, so even though the Fed is hiking, they want to get inflation down, which is bad for gold. Real yields are really surging here. And, gold's at 1850. Considering all these things, and you have this, the stock market's down 25% or wherever it is. I would think that gold would be down, holding up well, but it's correct. Its corrective low is 1670 or 1675. Gold's almost $200 above that. I think 1850 is the midpoint. I might be wrong, of this entire correction. So gold has, when you think about it, gold has held up really, really well. And, and perhaps that is helping out. I know the miners are underperforming, but perhaps that is helping out to some degree, because if gold were to fall to 1,700, or 1,675, you would probably see a lot more carnage in the miners. So that's also something I think about, that, gold is held up pretty well here. And if there's not going to be more than another hike or two, maybe gold is just going to, hold strong and not drop to 1,700.
Maybe. I really hope so as a gold bull, because I don't want to break that big picture chart that I first, began desiring the need for a correction as the top of the right side of the cup hit a higher high to whenever the last high was. What was that? 2011. It needed a handle, and it got a bigger handle than I thought it would at the time, but who can tell these things ahead of time? But so it's still, everything's intact. It's a bullish big picture. I don't want to see the 1600s, although a flash drop to there wouldn't break the situation. It could be a positive divergence by gold, where it's looking ahead, calling the Fed's bluff or calling the economy's bluff or whatever, and realizing that the Fed in its newly donned hawk suit is, just a kind of a paper tiger, pretending to be hawkish now, just as it pretended to be dovish previously and pretended it was not creating manufacturing this inflation that we're dealing with now. So they follow the markets. Real yields have been spiking. I've been watching that, and that too, like you say. So gold has held aloft. Has it just not gotten the memo and is going to kind of get shot out of the air like a clay pigeon? Or, are we not taking the bait if we're gold bulls and we're saying, this Fed hawk routine is going to have a limited shelf life? So I don't have the answer. I have technical parameters on gold, on silver, support. And actually, I just got done showing the line of demarcation for me on the HUI, where I'll start to really favor the final tank job scenario, if that's what's going to come into play. So this week's report you'll find is going to be a lot more conversational. I'm going to stop some of the just the routine charting and all that and get down to the points we need to talk about, so we're understanding what to be looking at, and then the if and or if then statements of, if this happens, then this is what we're looking at, While at the same time, I lost my guru hat, which I actually never owned, and can't predict the future, but I'm trying to be ready for whatever's coming.
Yeah, I think there's some guys on Twitter who claim they can do that, but that aside, can you talk about, because I think you've made this point in passing a couple of times, and it's really important, about how gold and gold stocks can bottom after they technically break down, and the charts can look really bad, but that can be when they look like they have this huge breakdown, but then and they do, but then it turns out that that's actually when they bottom. Do you understand what I'm getting at here? I don't know if I'm doing a good job.
Well, I'll just kind of riff on about, what I think we're talking about. And in my experience, gold stocks they can paint ugly charts and then follow through on those ugly charts. But when the crash finally happens, it's almost poetic in that it's like the final surrender of the inflationists, the ones who were packed in the sector for the wrong reasons, because, buy gold, buy silver, buy hogs, buy copper, buy oil. No, you buy gold during weakness, and when it would look forward to the new easing of policymakers, the new Dove regime or whatever. But it happens amid deflationary pressure. That's the best buy often for gold and usually for gold miners. So the important thing to remember about gold mining as an industry is that it leverages gold's standing in the macro. Gold will not usually move nearly as violently one way or the other. But if it is rising versus especially mining cost commodities like energy and materials, then that's usually happening during a deflationary episode or a waning market liquidity episode, and the fundamentals are improving, and that's when you buy. Unfortunately, the moves in gold stocks can be so violent that often you're buying a crash. So in 2008, Q4, I bought the crash at HUI 250, and then those knives went right through my palms, and I bought again at 150, which was finally the bottom. So you have to be careful. A crash always goes lower than you think it will. And again, I have to say I'm not predicting a crash for the reasons we talked about, where, it's possible enough pressure has been taken out of the sector in favor of other greener, more inflated pastures like energy. And until recently, some of the material sectors, specialty materials and whatnot. So conversely, gold miners also leverage gold standing to when it's negative. So the correction from mid-2020 to basically today has taken place with gold declining really significantly in relation to oil, to broad commodities, to many individual commodities, but that has started changing. And I see the energy complex now as the last inflated man standing. And when that man gives up, if he does, then it's time to really be a gold stock bull. But that doesn't mean run out and blow your cash right away. Because you need to realize that a lot of people will sell at precisely the wrong time, and it's not the most liquid market in the world to begin with, so that can create violent downside. So personally, I'm hoping for that, but I don't want to be a cheerleader for the crash scenario. I know that the slingshot that would follow it, that's when you really gain. And gold stocks are speculations on something that I consider not at all to be a speculation. It's just an anchor on the macro. A negative macro produces the appearance of a rising gold price because everything's falling in relation to it. The U.S. dollar has been a wild card, confusing a lot of people. I'm not saying I have it all figured out, other than it's been diverging the inflation for the last year, and it's the global liquidity receiver as the stresses in the asset markets accentuate. So quite often gold-silver ratio and U.S. dollar rise together as liquidity stress hits the macro markets. And so that's what we're looking at. But I'm also looking at an eventual potential for a significant pullback in the dollar as well, if and when the Fed flips.
Yeah, so one or two more things for you, Gary, and then I'll let you go. I guess the first thing is, I don't want to pinpoint the inflation down to one indicator, but the shift away from, okay, inflation has peaked and it's rolling over. Is energy the best indicator? Or give me a little color on the bond market. Even if you think energy is the best, is the bond market, how does that factor in?
Well, first of all, I don't think energy is the best, and I'm probably the furthest thing from an expert supply-demand fundamentalist about energy. So, I don't want to get too cavalier about that. I think energy is the last man standing, and I've seen over the years, no matter how good the story, when the macro turns, it turns on everybody. As far as the bond market goes, like I said, interest rates, yields have spiked right to a target. I believe that, there's a good chance that we've changed a secular situation in bonds that's decades old. And I use the 30-year yield the very long-term chart and its monthly moving averages to show that something has broken this year that had not broken for decades. So something has changed, and I'm not going to pretend to be able to divine it all right now, but I'm certainly going to be watching it and trying to establish narratives that make sense. So I think the bond market bull has ended with the big spike in yields. I also think that yields as part of the inflation trades have a lot of downside potential after making this signal that the macro has changed from a bond market perspective. So I'm I don't know if it's because it's a Saturday or what, or I've been writing all morning, but I know I'm hitting you with a big word salad here, but it's just, it is what it is. And I'm just kind of like letting you know what I see. And I need to package it in more understandable terms, hopefully nicely written paragraphs that will explain it a little better. But I don't even have it all figured out yet. So there we are.
Okay, Gary, last thing for you. Do you think the stock market is going to have some kind of a bear market rally or big counter trend rally? How do you see that? Or do you see a little more downside potential in the short term? How do you see that setting up?
Well, the story in the stock market using the S&P 500, global markets are a mixed bag, and there's a lot of different conditions happening there, including something interesting in China with a potential bottom. But the S&P 500 is in a massive bull market from 2009. Massive. I was just looking at it. I've got it in this week's report, the monthly chart. I also think that there's lower to go, even if this is just a moderate, normal cyclical bear market, which is all it is so far. We can't read anything else to it. I know that the world is ending. I know that there are all kinds of market watchers out there telling us why this is it. This is the big one. But I'm just going to be dumb and follow the charts like always. And this thing is in a massive, unbroken, but increasingly volatile bull market from 2009 to today. And there's support for the S&P 500 not too much lower, 3,200 to 3,400 area. So that's my answer. It's not a secular bear market in stocks. It is a cyclical bear market.
What would change your opinion? I mean, it's kind of hard to predict secular bear markets at the outset. What would shift your opinion that this is something more? This is going to be a more significant bear market.
Well, it could be the bear market in bonds, for all we know, right? What was the funding mechanism that the Fed has used routinely since 2000? Every time there was a problem, a liquidity problem, the Fed used that deflationary market signaling of long-term declining bond yields as its own little, toolbox or monetary playground. Every time there's a deflation scare, they can print money and use all the esoteric tools that they use. But that's the thing that concerns me is what if that tool is gone? So, I'd look at it fundamentally, the way they create the funny money, and realize that stock bull markets or this long-term bull market has been created from money creation, from money printing. So I don't see it in the charts. I do see it in mechanisms like that, though, where the Fed is losing a tool that it has routinely used, bond manipulation, to fund stock market growth.
Well, on that note, Gary, thanks so much for coming on short notice. I really appreciate it. And please tell our listeners how they can go to your website, how they can subscribe.
Sure thing. The website is N as in Nancy, F as in Frank, TRH.com. And there's on the top menu, there's a link called Subscribe Options and Info. And in fact, we've recently added very easy credit card sign up after all these years of just PayPal. So check it out. And there are also several posts, public posts I did on Friday and this week that kind of fill in some color as well as to what we're looking at. There was actually a pretty significant article on gold and gold stocks on, I think that was yesterday. So, yeah, check it out. Keep an eye on the website. And if you think I can help with anything, I'd welcome your subscribership.
Okay, Gary, on that note, thank you so much for coming on. Really appreciate it. Highly recommend all the listeners subscribe. And Gary, thanks so much, and hope we can do this again sometime in the next month or two.
Oh, I'm sure we will, Jordan. Thanks a lot. I appreciate it. Thanks for taking some time on your Saturday.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.